We often associate a fund manager with a certain style of investing. Oh, this guy is a value investor, this person is hunting for growth stocks, etc., etc. Many managers, in fact, most managers find it difficult to move from one style to the other, and even I went through that stage for many years. You see, it was Professor Bakshi who introduced me to the world of investing. He taught me and my classmates how to identify gaps between value and price, why we should apply a margin of safety, etc. And while this has helped me over the years and is still really helpful, I now realize that good education also creates an invisible boundary, something like a Lakshman Rekha which was blocking my mind, and I could never get myself to explore other concepts like technical analysis, growth investing, algo trading, etc. But one area I've built a lot of warmth towards is momentum investing. What exactly is momentum in an investing sense? Well, to put it in a cricketing analogy, when Yuvraj Singh smacked that fifth six against England in the 2007 T20 World Cup, the commentator Ravi Shastri could be heard saying,
"Every chance now. Yuvraj must be favourite here to put this sixth one into the crowd as well."
So what Mr. Shastri meant is that Yuvraj was on fire, that is, he had the forward momentum to continue doing what he was doing, and as expected, he smacked the sixth ball as well over the boundary. In technical terms, momentum is the tendency to persist, to continue, which in our language means investments that have performed well will continue to do well, and likewise stocks which have not done well in the past will continue to perform poorly. So if I connect back with what I was taught in my value investing classes, it's almost sacrilegious for me to think that one should invest in a stock that has gone up by 50-60%, but that's what momentum investing requires us to do, and we'll see in this video how this strange counterintuitive strategy has performed and why I think it's a must-have in our investing portfolios. Let's begin. The study of momentum as an investment strategy started somewhere in the 1990s when researchers like Fama, French, Jagdish, Moskowitz, etc. observed that momentum delivered returns that were often higher than a market cap or a value style fund. One of the explanations for this anomaly actually comes from behavioral finance, which says investors have a tendency to overreact or underreact to information that in turn shoots up the price of a stock or depresses it. Of course, over the long term, these distortions kind of reduce. That also explains why momentum investing is positioned as a short-term strategy that's often played out over a 3 to 6 month period. Now, because most momentum strategies are based on the price of a stock or an index, a portfolio of momentum stocks can be built with very little knowledge of investing, and all one needs is a standard screening software. So in its most simplest form, step 1 is to define the universe. And because I like mid-caps on a screener, I start by applying a market cap range of 25 to 75,000 crores. This gives me 155 stocks of all shapes, sizes and sectors, which brings us to step 2, which is where I sort these stocks on a descending order basis as per their share price return over the 6 months. This gives us a couple of public sector construction and construction linked finance companies at the top. Then there is ITI, which is another PSU, BSE Limited and a few more. And finally, step 3 is where we pick the top 10 stocks. So these 10 stocks that I've shaded here, and that, ladies and gentlemen, are your momentum stocks for say the next 3 to 6 months. Okay, so a list is a list, and the real challenge is to test out how the previous 6 months list would have performed in a real life scenario. So I pulled out the data from August of last year, and these are the 10 stocks that would have made up that month's momentum portfolio. I then computed the 6-month return for each of these stocks, and as a portfolio, this gives us a 34% point-to-point return, which is a lot higher than the Nifty 50 or the Midcap 150 that delivered 11% and 26% respectively. So momentum has worked extremely well over the last 6 months, but that might not be the case at all times. In fact, let's examine this with some data, and I shall be using the Nifty 200 Momentum 30 Index as a reference point here. So in this table here, I have the yearly returns for the momentum index, and on an overall basis, this index has done better than the Nifty in most years. In fact, certain years were extremely profitable for the momentum 30 index. 2012, 14, 15, definitely 2017, 21, and most recently in 2023, where this index delivered 23% returns. On the other hand, momentum had a relatively poor performance in some years, and most noticeably in 2018 and 2023. When we look at this visually, observe how well the momentum index does when there's a nice run up in the markets, as I've shown with these 4 circles. However, when the markets were flat or a little bearish, as we saw in 2018 and 22, momentum did not do well and in fact delivered negative returns. So this is something one has to be wary of, that is, momentum, much like a snowball, accelerates your returns when the stock markets are doing well, but when the markets aren't doing well or are range bound, then a momentum fund does struggle to deliver growth. In fact, hedge funds are famous for using momentum in either direction. That is, they buy stocks when there is positive momentum and they tend to short stocks when the momentum turns negative, thereby making money in both scenarios. Which brings me to M-Stock, the sponsor of this video and one of the few stockbrokers in the country that have built a zero brokerage model. Yes, you heard that right, zero brokerage, which means there's free intraday, free delivery, free F&O, free mutual funds, free IPOs and a lot more. And all of this can be yours by paying an account opening charge of just 999 rupees. Yes, just 999 for all this free stuff. And if you pay another 999, then you can also get rid of those quarterly AMC charges for the rest of your life. In fact, the M-Stock website has this detailed comparison table. And if you're someone who is into intraday, uses futures and options, does margin trading, which incredibly at M-Stock can be as low as 6.99%, then definitely check out M-Stock as it will help you save a lot of money. But money isn't everything, right? Trust is equally important, and pleasantly, M-Stock is backed by the Mirai Asset Group, which needs no introduction. It has over 8.5 lakh users, it did over 3.5 lakh crores of turnover, and is estimated to have saved 145 crores in brokerage last year. So save it, trust it, compare it, and don't forget to try it. As always, the link to this platform is available in this video's description. Okay, now let's look at how we as investors can participate in this momentum opportunity. Now, specific to indices, there are a couple of them in India, the Nifty 200 Momentum 30 Index and the Nifty Midcap 150 Momentum 50 Index. So the Nifty 200 one is mostly large caps, 70-75%, while the other one is entirely mid caps, and pleasantly both these indices have performed extremely well with a 5-year CAGR of 23% and 32% respectively, while the Nifty 50 has returned just 16%, yes, just 16% in the same period. 32% versus 16%. I know it's a lot, but just to put it in numbers, while a lakh of rupees invested in the Nifty 50 in January of 2019 would amount to 2.1 lakhs, the Nifty Midcap 150 Momentum 50 Index would have delivered a little over 4 lakh rupees. This is almost double. And if you have interacted with me over emails or on a one-on-one consultation, then you know by now why I have always insisted on having a momentum fund SIP in one's portfolio. Now, understandably, there are some subtle variations in the methodology and structure of both these indices. But all said and done, it's more of a call on whether you want to participate in a large and mid-cap or a mid-cap only category. Pleasantly, there are mutual funds and ETFs for both indices, and while I'm not good at differentiating one index fund with another, but if you must, then please look at your brand preference, then the expense ratio, which should not be too high or too low, and also have a look at the AUM, which should ideally be above a certain threshold, let's say 100 crores. In addition to passively managed mutual funds, there are also a couple of recently launched active offerings. There's the Samco Active Momentum Fund and also Momentum Fund by Quant AMC that both work on their own proprietary model. Now, in addition to mutual funds and ETFs, there are a number of small cases that are built around different momentum strategies. For more specifics, please look at the offerings from Right Research, Capital Mind, Weekend Investing, Windmill Capital, and dozens of research outfits that have their own methodology, fee structure, and of course, performance counters. In fact, if you want to draw a difference, a comparison between a passive momentum fund and an actively managed instrument, which can be the Samco Quant kind of thing, or small cases, or even PMS offerings, then from a universe perspective, while index funds are restricted to large caps or mid caps, and there's a defined number of stocks, active funds have a more broader mandate. While passives are always invested, active funds tend to come in and out of the market depending on the conditions. The rebalancing in an index fund is fixed and rigid, while their active counterparts can rebalance as and when required, which is very useful in the event of a sudden price shock. In terms of the strategy itself, while the indices use relative momentum, actively managed funds use a variety of methods which I'll briefly take up in the last section of this video. And of course, these small cases, PMS and active funds have a much higher expense structure as compared to index funds and ETFs. Honestly, I don't have a view on which is better, active or passive investing, but I must insist that everyone should explore momentum investing. And personally, I have committed to build up a momentum portion of my own portfolio to between 12 and 15% over the coming few quarters. Alright, now that we understand the basics, the meaning of momentum, its history, how to build a simple strategy, the performance, etc., let's go a little deeper and understand some of the different momentum strategies that my research threw up. In fact, let me list down the different momentum strategies before I discuss a couple of them. So as we have discussed in this video, and the most basic of strategies is price momentum. That is, we invest in stocks that have shown strong price performance in the recent past, and the assumption is that the price will continue its upward trajectory. Additionally, we have something called relative strength momentum, wherein an asset is compared with its benchmark. There is cross-sectional momentum, where the price movement of two stocks within the same sector are compared. Time series momentum or trend following is yet another technique. We also have moving average momentum, which is used by traders and investors alike. 52-week high momentum, dual momentum, which I'll be discussing in a bit. Then there is volatility momentum, earnings momentum, fundamental momentum, smart beta momentum, global macro momentum, and so on. For instance, the 52-week high momentum strategy is a popular one and revolves around the idea that stocks that have reached or are very close to their 52-week highs will continue to perform well, at least in the short run. The selection of stocks is generally done by pulling out the 52-week high stocks that you can find in any screening platform and then applying positive momentum factors on it like trading volumes, favorable news, positive earning surprises, etc. Another technique that I've discussed in another video on my channel is the combination of momentum and value, which plays on the central idea that the momentum factor and the value factor, in spite of both being equities, are weakly correlated, and by doing an equal weighting, so a 50-50 allocation, one can potentially achieve around 15% per annum on a 3, 5, 7, 10-year rolling basis. It's a very interesting video. I have explained everything with historical data there, and I think it's something you should definitely consider if you're creating a long-term passive investing portfolio for yourself. Yet another variation within momentum strategies is dual momentum, which was first put forward by Gary Antonacki in his book that goes by the same name. So as one might expect, there are two different momentums at play. The first is absolute momentum, wherein the recent price performance of a stock is compared to its own historical performance. Like in the case of Varun Beverages, it's 1346 divided by 652, which gives us an absolute momentum score of 2.06. The second part of dual momentum is relative momentum, and very simply, it's a comparison of the stock's performance with something broader such as a sector or an index like the Nifty 50. Since Varun Beverages and the Nifty 50 were up by 106% and 23% respectively in the last 12 months, this gives us a relative momentum score of 4.47. On the other hand, if we do these calculations for HDFC Bank, then minus 12% divided by 23% would have given us a score of minus 0.53. The next step is to combine these two scores using a suitable weight, let's say 50% each, which will give us a dual momentum score, which in the case of Varun Beverages comes to 3.26. The final step is to rank different stocks per the dual momentum score, pick the top 10 to construct this portfolio and to rebalance it on a timely basis. Techniques like these are being used more commonly now. I think Samco's Momentum Fund also works on dual momentum, which makes the understanding of this concept all the more important. So this was just a quick primer on advanced momentum techniques I wanted to share, but the fact remains that momentum as a strategy is there to stay as it continues to capitalize on the market trends and yield significant returns over time. So if you don't have momentum in your investment portfolio, then do give it a serious thought, and if you have any questions, do let me know in the comments box below. Once again, thank you for your time. Do participate in my newsletters Momentum. It's already crossed 13,000 subscribers. Share this video, like this video, and I'll see you very soon. Until then.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.